Well, a little bit, but the lack of yield around the world is still a significant issue here. And then the data that has been coming in over the last month or 6 weeks has been weak also. So the trend is your friend here. And at Washington Crossing Advisors, we're still optimistic. We're still overweight equities. But at the beginning of the month, we cut back our equity allocation because we did see data slowing, suggesting a greter chance of a slowdown, particularly overseas.
But the trend is your friend until it's not. And it's
Yes.
hard. I mean, in retrospect, it seems obvious when these things change. But at the time, so take a sector like utilities, which just continues to be at 52-week highs day after day. You really feel comfortable telling people to stick with that trade?
Well, if you look at where we're headed, bond yields in the United States have come down, but they're much lower elsewhere around the world. It's been well covered. We have negative yields all over the place. So someone is buying these bonds, and consequently, as we move forward and deeper into the expansion, we are expecting lower returns. So at Washington Crossing, given the change we've seen in the data, we've actually cut back our equity allocation, and we've actually lifted our exposure to gold and cut back our overweight to high yield.
And Will, while this has been going on, 2 weeks ago, a week and a half ago, is when money market funds assets hit their highest level in 10 years. That was the week that we saw that 800-point decline there. So a lot of people are piling into cash right now as well. That's becoming a crowded trade, if you will.
Yeah, I mean, next thing we're going to have people putting money under the mattress again with, $18 trillion worth of
where would you put money to work then?
Well, myself, I'm a favor of gold. I believe that gold should be a part of everybody's portfolio. And, the reason why gold has been increasing, obviously, over the last, few months or so is that's the kind of canary in the coal mine, in my opinion, that really is sounding a broader alarm about the global economy. So gold and then,
as a safety trade, not an inflation hedge, I assume.
No. I think at the moment it's much more of a risk management tool. And so putting a piece of gold in your portfolio, I think it's much more a risk management tool rather than an inflation hedge. And I think, non-traditional forms of income are also interesting. So moving away from these utilities and other more traditional forms, which have been bid up by the market over the last few years, and things like BDCs, REITs, MLPs, non-traditional forms, which still give a very nice yield, but maybe haven't been bid up as much as some of the other sectors.
In those business development companies, real estate investment trusts, a lot of acronyms flying around once you get into the alternative world. A crazy stat, Kevin, that I saw lately is that 95% of the investment grade debt globally that delivers any yield is U.S. So in other words, you have to come here, and that wall of money is coming here in order to pick up any spread at all right now. For U.S. investors, should they participate in that game, or should they look elsewhere?
Well, as a U.S. investor, you're basically a price taker. So if you're looking out 10 years and that's your horizon, whatever your yield is on, let's say, the 10-year Treasury is your yield. But take it from a different perspective. What if you're coming from a place that's maybe in the emerging markets, where you've got concerns about things like property rights, where you don't have a lot of safe places to put money? Where else are you going to go? And if you went to Europe, a lot of those bonds have been bought up by the ECB.
Right.
So when you think about the places to go, there really has not been a lot of places to go for safe money. If you're a global investor, it just so happens that those flows are impacting our interest rates here in the United States, conveying a benefit to borrower, but not...
Absolutely. But all that being said, does this change on a dime as soon as, or if, who knows if it happens, but you have to be aware of the risks, that there's a better trade sort of tenor with China, all of a sudden a different situation, the Federal Reserve cuts rates, a couple more times. I mean, are those the kind of events that can take these stats that we've been talking about and all of a sudden spring people to the other side of the trade?
Well, they can, but probably not immediately. The trade flows, the current account imbalances that have existed for decades, for example, those are very much the taproot of where a lot of these what has created a lot of the current global interest rate environment dynamics. That's taken years and years and years to emerge, and it's probably not going to go away overnight. But you have to be mindful of that.